Income tax planning through deductions. Taxpayer in India for the purpose of income tax includes individuals, Hindu undivided family, association of persons, body of individuals, firms, and companies. Each of these taxpayers is taxed differently under the Indian income tax laws. While firms and Indian companies have a fixed rate of tax of 30% of their profits, the individual, HUF, AOP and BOI taxpayers are taxed based on the income slab they fall under. Higher the income, higher the tax slab rate and resulting tax liability. Income of the taxpayer is classified into 5 heads. First, income from salary that includes HRA, leave encashment allowances, perquisites received from the employer, etc. Second, income from business or profession that is the profit or loss arise on carrying on business or profession. Third, income from house property such as rental income. Fourth, income from capital gain that is the profit or loss on sale of capital assets such as sale of land or building, plant and machinery, etc. And last, income from other sources that includes interest of saving bank account, fixed deposits, lottery winnings, family pension or gift received, etc. Sum of all head of these income is equal to gross income. Government is allowed to deduct certain investment and expenses from gross income. After such deductions, we arrive at the taxable income. Tax is then finally calculated on taxable income and paid to the government. Therefore, we understand from the above discussion that in order to reduce the tax liability, we have to do the tax planning and investments in such a way that maximize our deductions. Higher the benefits of deductions, lower the taxable income and thereby lower the resultant tax liability. With proper tax planning, we will be able to make a considerable amount of risk-free return from the investment schemes and also save on net tax payment. We will be discussing in brief the deductions available under various sections for individual and HUF. The most widely used deduction is deduction provides under Section 80C with maximum limit of 1,50,000 rupees. It means a taxpayer is allowed to reduce his gross income by 1,50,000 by investing under various investment scheme of Section 80C and reduces the tax liability. Investments such as Employee Provident Fund, Public Provident Fund, Sukanya Samriddhi Yojana, National Saving Certificate, Senior Citizen Saving Scheme, Equity-Linked Saving Scheme, payment made towards life insurance premium, payment made towards principal sum of a home loan, tuition fees, etc. are some of the investments falls under Section 80C and eligible for deductions from gross total income. Let's discuss few of these investment in detail. To start with, let's discuss about the Employer Provident Fund. Both employer and employee contributed to Provident Fund. While employer's contribution is exempt from tax, employee's contribution is counted towards Section 80C investments. An employee have the option to contribute additional amount towards PF through voluntary contribution. Further, interest gains on such investment is also exempt. Next is Public Provident Fund. PPF is one of the best assured return savings scheme where interest rate is around 7.1%. Lock-in period for the deposits is 15 years. Investment under PPF falls under overall limit of 1.50 lakhs of Section 80C. For instance, a salaried individual falls under 30% tax slab gets dual benefits by saving an amount up to 45,000 rupees of tax, that is, 30% of 1,50,000 by depositing into PPF account and also earn tax-free interest at a rate higher than FD's return. PPF operates on the EE model of taxation whereby investment, interest accrued and withdrawal from PPF is fully exempt from tax. No doubt, it is one of the best tax-saving instruments, but people often complain that it lacks liquidity due to higher lock-in period of 15 years. This is not completely true. Loan facility up to 25% of the amount deposited is available without losing tax benefits from the third financial year. Interest rate for loan is 2% above the interest rate of PPF account. Further, partial withdrawal facility for 50% of the amount deposited is available from 5th financial year onwards in certain special cases such as treatment of specific disease or for higher education. Another scheme of such type is National Pension Scheme. Both PPF and NPS are the retirement scheme. PPF is a fixed interest paying instrument while NPS is partially linked to the market. Both the instrument comes under EEE, that is, no tax at the time of investment, accrual of interest and withdrawal of such investment. Therefore, one must be careful while considering various investment schemes under the section to gain maximum tax and investment gain advantage. However, PPF is fixed interest paying instrument while NPS is linked to the market partially. It means, considering ROI, based on the past data, investment of 10,000 in PPF accumulate a total amount of 2.29 crores at the end of 35 years at 8% ROI, whereas the same amount invested in NPS accumulate a total amount of 3.56 crore at 9.75% ROI at the end of 35 years. Another type of scheme under Section 80C is Equity-Linked Savings Scheme. There are mutual funds which are specified for tax-saving purposes. An investor can cumulative claim deduction under Section 80C up to 1.5 lakhs by investing in such funds. These funds have short lock-in period of 3 years and give customer exposure to equity markets. Average gain under ELSS is 12% to 15%. It means, a taxpayer can save the tax up to 45,000 by investing 1,50,000 in ELSS schemes and additionally earn income of 12% to 15% as well. 10,000 rupees invested for 35 years at 8% ROI is 2.29 crores, and at 9.75% ROI is 3.56 crore. Would you imagine what is the amount it become if invested with 12% to 15% ROI? Power of compounding, rightly said, is the eighth wonder of the world. Further, government in order to facilitate taxpayer for acquisition or construction of the house provides deduction in respect of principal repayment and interest repayment on home loan. Principal amount of home loan qualifies for deduction under Section 80C along with the amount paid towards stamp duty, registration fees and other expenses paid at the time of such purchase. The maximum amount of such deduction is 1.50 lakh per year. Further, the interest component of home loan is available for deduction under Section 24B subject to maximum additional limit of 2 lakh other than 80C deduction. It means one can claim deduction for both principal and interest repayment. There are other investment options in Section 80C such as Senior Citizen Savings Scheme, Sukanya Samriddhi Yojana, 5-year Post Office Time Deposit Scheme, 5-year Bank Fixed Deposits, Infrastructure Bonds, etc. Additionally, the taxpayer can claim the deduction of 50,000 rupees in National Pension Scheme under Section 80C 1B. This deduction is over and above of Section 80C deductions as discussed earlier. For instance, if you are in 30% slab and you would not have deposit the amount under this section, your tax liability is 30%, that is 15,000 rupees, and logically you left with 35,000. Moving further, Section 80D deduction is available for an individual and HUF in order to promote health insurance and to provide for medical expenses. An individual can claim the deduction for himself, spouse, dependent children and parents, whereas HUF can claim deduction for its members. An individual gets the deduction of 25,000 rupees for the insurance premium paid by him for himself or his family members and 25,000 rupees for the premium paid for his parents, whereas a HUF gets deduction of 25,000 rupees for the premium paid for its members. However, if any of the family member or parent is senior citizen, then the amount allowed for deduction is 50,000 rupees instead of 25,000 rupees. An amount of 5,000 rupees is available for deduction for preventive health checkup subject to maximum limit of deduction. Further, in case of senior citizen, an additional amount of 50,000 rupees is allowed as deduction for medical expenditure provided no amount has been paid towards health insurance of such senior citizen. Last, additional deductions for expenditure incurred for the premium, medical treatment, training and rehabilitation of a disabled dependent is allowed under Section 80DD, and deductions of expenses on medical treatment of specified ailments such as AIDS, cancer and neurological diseases is allowed under Section 80DDB. with the risk of sound repetition. Deduction available under the section is over and above the deduction available of 1,50,000 under Section 80C. Further, Section 80E provides for deduction in respect of interest on loan taken for higher studies in India or outside India. Higher studies include the vocational courses as well as the regular courses pursued after passing the senior secondary examination or its equivalent exam. The deduction is available for the higher education of self, spouse or children or the student for whom the individual is a legal guardian. The deduction is available for the total interest paid on such loan for 8 years starting from the year in which individual starts paying interest on such loan. Again, this deduction is over and above the deduction of 1,50,000 under Section 80C. Last, but not the least, deduction in respect of donations to certain funds, charitable institutions, etc. is also available under Section 80G up to 50% or 100% of the amount contributed subjected to the maximum limit of 10% of the gross total income of the assessee. And 100% deduction in respect of contributions given by any person to political parties is available under Section 80GGC. There is no limit on such deduction and an individual can claim any amount of deduction by donating to political party. Further, for salaried employees, exemptions such as house rent allowances, leave travel allowances, children education, reimbursement of expenses etc. plus standard deduction of 50,000 rupees is also considered to arrive at net taxable income. Till now, we have discussed all the major deductions available to individual and HUF. The taxpayer must plan at the beginning or during the financial year and carry out the appropriate investment in order to gain maximum advantage out of such deductions. For more information, visit to our website www.bijproud.com or write to us on inquiry@bijproud.com. See you in the next video. Till then, goodbye.